Okay. So when we left off last Thursday, we had covered the allowance method, and we had dealt with, like, you know, debiting bad debt expense and crediting allowance for doubtful accounts when we're dealing with the allowance method. And we kind of looked at what happens when you write off accounts under the allowance method. So just as a review, as we're getting into how we actually come up with those estimates, if you remember, the direct write-off method we can use only if we're like a cash basis or, you know, not a GAAP compliant corporate accounting structure. So direct write-off, we truly just write off the account to bad debt expense and credit their accounts receivable directly. So we kind of learned that. And then we got into the allowance method. So the allowance method is required to be GAAP compliant, okay? And under that, instead of writing off direct accounts, we did an adjusting entry at the end of the year saying we estimate so much is going to be uncollectible. We still debited bad debt expense, but we credited allowance for doubtful accounts, that contra asset account. And then as we move into the next year, as we write off accounts, we're debiting allowance for doubtful accounts and crediting the specific account. Okay, so that allowance for doubtful accounts starts with the credit balance at the end of the year, and then we debit it as we go through and reduce that balance, okay? And then we just do it all over again, right? We get to the end of the year, we estimate uncollectibles, we credit allowance for doubtful accounts, and then we debit. So it's very cyclical. It's an adjusting entry. So the part we left off on was, well, how do we figure out how much is uncollectible? You know, they were just giving us an amount. Well, now we're going to learn the two main methods that we use. So there's two methods to actually estimate uncollectibles. We have percent of sales method, and we have analysis of receivables. Okay. So when we are looking at percent of sales, they're truly just going to give us some type of percent. And I think we may have covered this briefly. So when it's percent of sales, they give us some information like our accounts receivable, the allowance for doubtful accounts, total credit sales, and bad debt is a percentage of credit sales. So in this case, they're estimating 0.75% or 0.75% of credit sales are going to be uncollectible. So when you're using a percent of sales method, you truly just take the total credit sales of 3 million times 0.75% or 0.0075. And you would get an estimate of 22,500 is the bad debt expense. And then you would just do your, this is at the end of the year, so we're doing an adjusting entry. So then we debit bad debt expense and credit allowance for doubtful accounts, that 22,500. Pretty easy, right? There, they're showing the journal entry. Okay. So again, whether we use percent of sales or an analysis of accounts receivable, this is always an adjusting entry done at the end of the year, a debit to bad debt expense and a credit to allowance for doubtful accounts. We're just coming up with the amount. Okay. So the other method that we use is called analysis of receivables. It's a little more accurate because we're actually going to look at, and I think we briefly looked at this last Thursday, you know, how old are these accounts? And the older they become, the higher the likelihood is that we're not going to see that money, okay? So instead of just going off of credit sales, now we're looking at what's actually owed to us in accounts receivable and how old is it? And then we're going to be more uncollectible the older the debt is. So there's some steps we do. Well, we figure out the due date of each account, you know, to see how old it is. And then we calculate the number of past due it is, the number of days it's past due. Okay. And then step 3, we're going to look at each account as placed in the age class according to how past due it is. So if it's 1 to 30 days past due, it goes in one column, 31 to 60, another, 61 to 90, and so on and so forth. Then we total up the amounts in each day category, okay? And then they're going to give you the percentage that's uncollectible based on how old each account is. So, you know, if it's 1 to 30 days past due, it's probably going to be like 2% or 5%, something low, because, you know, if someone's just 1 or 2 up to 30 days past due, there's still a high likelihood they'll pay. They're just late. If it's over 120 days late, it may go up to 60% or 80% because obviously the older it gets, the less the chances that we'll actually see that money. So then we just multiply each total by a percentage and add it all up to give us our total uncollectible amount. So this is called aging the receivables, or analysis of accounts receivable. So an aging schedule would look something like this. We have, for this instance, they have a list of all the customers. They're not showing all of them, as you can see, but they're giving you a highlight. Each customer has a balance due, and in that we're categorizing it. Is it not past due? So it's not even due yet. It's not old. Is it 1 to 30 days past due? Like I said, 31, 60, 61 to 90, and on out. So then they're looking like Ashby and Company. They have $1,500 due to us, and it's in the 31 to 60 days past due. So not super old. Whereas BT Bar has $3,500 that's 91 to 180 days old, and then $2,600 that's 181 to 365 days old. So over 6 months without paying. We probably won't sell to them right now, right? Yes, sir.
How does that work with like collections? Where if you because if you usually about 3-4 months going to collections, how much you wrote that off? Or how does this work?
This is probably an example of a company that handles their own collections. If they were to sell those collections off to another company, then they would write off that debt. So yes, but this would be an example of someone that, a lot of companies have their own collections department. And so we're going to assume that they have a collections department, or they don't write off debt until it's a year past due. It depends on the company. Companies make up their own rules on when they send things to collections and whether they handle collections in-house. That's a good question. So every company is a little different. Standard, probably 90 days past due is a good indication, but sometimes it works a little differently too. When these customers are businesses, we tend to give them a little more chance, I guess you could say, because we have some history with them and we're trying to sell to them. But obviously we want them to pay. So yeah, in this case, I would make the assumption that this company handles collections in-house, since they have some that are really past due. So they just add up. So as you can see, we would total up, and again, they're not showing us every company, but all total, we have $240,000 in accounts receivable. Of that, $125,000 is not even past due. It's not due yet. So it has about a 2% chance at that point of being uncollectible. And then as you move through, you can see it gets all the way up to, if it's over 365 days past due or over a year past due, we're pretty confident that we're not going to see that money. So it's at 80% uncollectible. So they'll always give you the percent. They'll give you the days past due and the percent uncollectible. And then you're just multiplying. So 125,000 times 2%. We estimate that current collectibles, we have about $2,500 uncollectible. And we just multiply all the way down. And then we add it all up. 2,500 plus all of those. Our total estimate of uncollectible accounts is $26,490. So that's how they're coming up with what they think is uncollectible for this year based on accounts receivable. Okay, so this is probably the more common method because it is more accurate. You're looking at accounts receivable specifically and not just credit sales. Okay. So now here comes the only tricky part, because really doing an aging schedule is pretty easy. You've come up with that amount. We've determined that $26,490 is not going to be collectible. So you would assume, based on what you already knew, that's what you debit and credit to bad debt and allowance for doubtful accounts. However, there's one caveat. As you can see, that's not what we debited. We have to consider what's already in that allowance for doubtful accounts balance. Okay. So remember, we have allowance for doubtful accounts. That's a contra asset. So, at the end of last year, we credited allowance for doubtful accounts for whatever we thought was going to be uncollectible. Throughout the year, again, we debited specific accounts to write them off. So it's telling us at the end of this year, before we do our new adjustment, allowance for doubtful accounts has a credit balance of $3,250. Well, allowance for doubtful accounts is a permanent account. So it's going to keep going over and over, just like accounts receivable. So some of what's left in this allowance for doubtful accounts was probably based on accounts receivable that's still there and present. So what we have to do is we have to consider this balance when we're doing our adjusting entry, just under the receivables method, okay? So only on the receivables method, we have to look at allowance for doubtful accounts. Basically, our goal is we want this allowance for doubtful accounts to have an ending credit balance of $26,490. Okay, that's the amount we calculated. So we want allowance for doubtful accounts to have a balance of $26,490. So the reason you don't have to do this with the percent of sales method is if you remember, sales is a temporary account. Sales gets zeroed out at the end of every year. So when we base it on credit sales, that's credit sales for this year only. Okay, so we don't really have to worry about what's in this account because sales get zeroed out every year. So when we're only calculating percentage of unreceivable or of sales for the current year. So when you do percentage of sales method, it's easy. You don't have to worry about what's in this account. But accounts receivable is a permanent account. So of the full whatever we had, what, 240,000 in accounts receivable, some of that was from last year too. You know, it's continuing on and on. We may have not written it off yet. So when we use an aging of receivables, we come up with the amount we want in allowance for doubtful accounts. If it's a credit balance, if it has an existing credit balance, we're going to take the balance minus the existing amount to get the adjustment. Okay. So if it starts with a credit, we'll take our estimate minus that credit balance to get the adjustment amount of $23,240. And as you can see, that's what we would debit to bad debt expense and credit to allowance for doubtful accounts. So this is probably the trickiest part of Chapter 8. And it's also remembering that under direct write-off or percentage of sales, they may give you the balance and allowance for doubtful accounts, but you don't need it. So don't let that trip you up, okay? So you only consider the balance and allowance for doubtful accounts when you're using an analysis of receivables method, okay? Now, the other tricky part is allowance for doubtful accounts, if you remember from last week, could have a debit balance, right? If we had written off more debt than we had, you know, estimated, it could have ended with a debit balance, okay? So in that case, we'll just kind of look at it. What if that balance was a debit balance of $32.50? If it started with a debit balance and we need to get to $26,490, we're going to add. Okay, so I would add those two together. So how much would that be? I'll let y'all do the math. $29,000, right? 740? Is that what you guys got? That looks right. Good. So their adjusting entry would actually be higher, right? You would get 29,740. So if there's a debit balance, we're going to take our target estimate amount and add that debit to it. Fun stuff, right? Not too bad. Once you practice it a couple times, it's not too bad.
So sorry, you guys.
Do what?
So why you have that number up here on this side? You have 3250 at the top.
Uh-huh.
This side. So,
Yeah, I was showing the difference. So your adjustment amount is going to be different depending on if allowance for doubtful accounts has a credit balance to begin with or a debit balance to begin with. Yeah. What was the other question? Yes.
Oh, so that 3250, is that at the end of this year? Is that what that is?
Yes, that's the balance and allowance for doubtful accounts before we do that adjustment. So
So that 26,490 was what we had over time.
that was what we calculated in this. So that is always your estimated percent of receivables. So that's what we calculated based on our current receivables, our aging or analysis of receivables. That's the estimated uncollectible. So this 26,490 is what we think out of all the accounts receivable we have is not going to be collectible. So that's the amount we want in allowance for doubtful accounts. So then we have to look at, well, what's already in allowance for doubtful accounts? Okay. So again, if it had an existing credit balance, we would subtract to get the adjustment. But
Oh,
then
so
like,
3250 was the already existing?
Yeah, that was the balance before adjustment. So in this case, it had a debit balance because it can be either a debit or a credit balance. So in this case, if it had a debit 3250, we would add this estimated amount plus that 3250 to come up with how much we need to do our adjustment for. The example on the PowerPoint was assuming that it was a 3250 credit. So then we subtracted to get 23,240. So a little tricky, right? So just remember, I would put in your notes, if allowance for DA has an existing credit balance, you're going to subtract. If it has a debit balance, you're going to add. Because you're always trying to find how much you're going to put in your adjusting entry. Okay? So you've already solved this, and they give us this. This is what we're working towards. It's a little tricky, yes.
Sorry, you said that if it's the credit you add, if it's a debit, you subtract.
So if it's a credit, subtract. If it's a debit, add. So what I want to do is switch over to the Chapter 8 practice, and we'll work on a couple of these. So you should be on number 3, I believe, on the practice.
I have a question, just so, because I don't want to doubt myself.
Sure.
So, does it increase on the debit side, or does it decrease on the,
Technically, allowance for doubtful accounts increases on the credit side.
Okay.
Yeah,
Is that
good
because
question.
the contra asset?
Yes, yeah. So that's very good. So allowance for doubtful accounts is a contra asset account. So technically, its normal balance would be a credit side.
Similar depreciation,
Yes, yeah, just like accumulated depreciation.
that's next chapter.
It's not bad. I think this is
It was,
harder.
yeah, it
probably.
was easier. I did the practice stuff I was going to do.
Oh, right, yeah.
And then as soon as I got done, I got the.
The email from me, like, hey. Now you're ahead. Yeah.
So when we had the existing number in credit side,
Uh-huh.
we debited bad debt expense and credited allowance for doubtful accounts.
Yes.
So is that the same that starts on the credit side?
Good question. Yeah, your journal entry, I don't have the PowerPoint up anymore, do I? Your journal entry, regardless, will always be a debit to bad debt expense and a credit to allowance for doubtful accounts. Just how you get that adjustment amount differs. But yeah, your journal entry is always going to be debit to bad debt expense, credit to allowance for doubtful accounts. Good question. Okay. It's a fun way to start your morning, right? Like hammering the hard stuff in. So let's practice a couple just so you can kind of see how it works. So this one's estimating allowance for doubtful accounts. And here they're giving us that aging or that analysis of accounts. So they're telling us, not past due is 1% uncollectible, up to 30, 3%, up to 60, 12%, so on and so forth. So we want to estimate the allowance for doubtful accounts based on this aging schedule. Excuse me. So what we're doing here is truly just going to, they've already given us the totals and they put in the percentage uncollectible. So this part's the easy part. You're truly just taking on the not past due, you're taking 1% of 607,400. Okay, well, that's easy, right? You can just take off a couple zeros. So it'd be $6,074. Okay, $6,074. On the up to 30 days past due, we estimate 3% of the balance is uncollectible. So how much would be uncollectible up to 30 days?
690.
Very good, 6,990. Moving over there. 6,990. What about the 31 to 60, 12% uncollectible? Very good, 14,592. And then the next one we have 61 to 90 is 30% uncollectible. So what did you guys get for that one? 28,950. And then the last one is over 90 days past due. And so what percent or how much is uncollectible there?
49.5.
Very good, 49,500.
And then for the balance, you should add all those up.
That's exactly it. Yeah, to get the total, the balance is going to be the total estimate here. So we're just going to add those 5 up. So what is our total estimated uncollectible? Very good. It's an odd number, right? 106, 106. Well, I guess it's even, but it's strange. Okay. Okay. That's it on that one. That one's, we're going to ease into it, right?
So that 106, 106, that would be our 26,000 or 29,000.
It would actually go here. So
my
that,
bad, you added
yeah.
it.
The 106, 106 is our estimated percentage of uncollectibles. So that 106, 106 would be right here. Yeah.
And that'd be before the adjusting entry, the journal entry?
Yeah, what we would be doing at that point is we would have to know what was in allowance for doubtful accounts. But that's the balance we would want. When we're finished doing our adjusting entry, we want this balance to say
That's what we're estimating.
106, 106. So we would have to figure this out.
Oh, this is what we did.
Yeah. So we don't know. They didn't give us that information, so we don't have the calculation for it. But we will on the next one. So this one's just showing you how to do an analysis of accounts receivable or that aging schedule. Okay, so that one's easy, right? Do
There
it.
should be a lot of those.
Doesn't have to.
Sure, yeah, just multiplying, right? I don't know, percentages throw students off for some reason, so you'd be surprised. Yeah, especially if it's like a fraction percent. Yeah. It's a little confusing. So this one's, well, kind of based on the last one, if you can tell. Evers Industry has computed that the proper balance as of July 31st is 106, 106. Well, that's what we just had, right? That's what we just analyzed and came up with. So it says, assume that the allowance for doubtful accounts has a credit balance of 8,240. So that means before we do any adjusting entries, allowance for doubtful accounts had a credit balance, a beginning balance of 8,240. So that's what we call the balance before adjustment. So it wants us to journalize the adjusting entry for uncollectible accounts as of July 31st. Well, again, this is the balance we want. This is the current balance. So what would I put, what's my adjusting amount?
97.
Yeah, 97,000, what was that, 866, yeah. And how did you get that?
I just subtracted 8,240 from 106 as the credit.
Very good, yeah. So in that case, we had a credit balance before the adjustment. We want it to be 106, 106. So we take 106, 106, fun to say, right? Minus that existing credit balance of 8240. So our adjusting entry amount should be 97,866. Okay. Does that make sense?
Can we go back and look at this, like, we open this and
You absolutely can. When we're finished with it, you can like save it and then or submit it even, and you should be able to go back in and look at everything. So in this one, again, your journal entry is the same as it is under percent of sales or anything. Bad debt expense is debited, 97,866. And allowance for doubtful accounts is credited, 97,866. And that's the adjusting entry. Their fiscal year ends July 31st. Any questions on that one? Okay, we have one more of this and then we'll switch gears. So let's do another example though. So this one, Outlaw Bike Company, is a wholesaler of motorcycle supplies. They give us their aging. So they've already done the aging for us. Always nice. And let us know, estimated uncollectible accounts percentages and what the accounts are. So what this is telling me again is our total accounts receivable is 1,401,800. Let me move this over just a little bit. And based on this aging schedule, we're estimating our total percent uncollectible will be 63,410. Okay, 63,410. So where would I put that 63,410? Very good. It's going to go in as my balance. So they've already done the schedule for us and estimated the 63,410 is uncollectible based on accounts receivable balance of 1,401,800. Now our question, it says, assume that the allowance for doubtful accounts for Outlaw Bike Company has a debit balance of $5,140. So again, that's the balance before adjustment. So this one has a debit balance of $5,140. So what would I do to calculate my adjusting entry?
Just add it to your balance.
You would add. Very good. So it has an existing debit balance. We would take that 5,140 plus the 63,410. Okay, so this one is a debit. So what is that? 68, 550?
So that allowance for doubtful accounts is a contra asset, right?
Mm-hmm.
So should your plus and minus be on the opposite side?
No,
Or no?
it's a contra asset. So the accounts receivable increases on the debit side. So since allowance for doubtful accounts is a contra asset, it increases on the opposite or the credit side.
Oh, okay.
But, it's really,
It just keeps throwing me because I keep thinking debit, you add it together, but there's a negative or minus sign above it. So I'm just like,
right. Yeah, with allowance for doubtful accounts, it has a normal credit balance, but before adjusting entry, it can have a debit balance, and that's what makes it kind of special.
Okay.
Because we normally don't see that, right? Like normally if our accounts have a normal credit side, that's the balance they carry. And what you really need to think about though, is when you do that adjusting entry, it should always end with a credit balance. That's kind of the purpose of doing this adjusting entry, is to make sure that that account is accurate. Okay, so this one had a debit, so we added, but your journal entry again is still a debit to bad debt expense and a credit to allowance for doubtful accounts. And it's the 68,550. Okay, 68,550. Any questions? That's our last little example on that one. So, you guys good? Semi good? Mostly good, right? On a scale of 1 to 10, how good are you? No, I'm just kidding. Like a 4.5? No. So this little slide just kind of compares the direct write-off method to the allowance method. Okay, so again, oh, I did not hit that. That was awesome. Must be on the timer. So direct write-off method, the bad debt expense is recorded when we just determine that a person is not paying and we write them off. Bad debt expense is recorded under the allowance method as an adjusting entry at the end of the year. Allowance account, we don't use an allowance account under the direct write-off method, but we do under the allowance method. Makes sense. Again, direct write-off method is going to be used for small companies or companies with few receivables. So they're not a publicly traded corporation. So allowance method is going to be used when we have a large amount of receivables. And will have to be used if we're a publicly traded corporation. So again, direct write-off method is the easiest one, but it's not GAAP compliant. Allowance method, you have two estimates. You could do % of sales or an analysis of receivables. Okay. Again, when you do % of sales, you're still debiting bad debt expense and crediting allowance for doubtful accounts. You just don't have to consider the existing balance.
So whatever that number you got is what you'll debit and credit.
Yes, exactly. So whatever % you come up with is your adjusting entry amount under % of sales. Okay. So it's only when you do the analysis of receivables that you have to worry about an existing allowance for doubtful accounts balance. Okay. Fun stuff, right? My suggestion is to start working on the Chapter 8 homework, over the next few days before next week. And then, if we need to go over a few things, if y'all have questions on the homework, we can deal with that before we get to review day. So I'd rather go over it sooner rather than later. We'll still review, we'll do a thorough review, but I want you by the review to just, need some key points hammered in and hopefully understand it. It'll make it easier. Okay, well, switching gears a little bit, we're still under receivables, but now we're looking at notes receivable. Okay, so we're switching gears. This is not too bad. Like I said, really, the toughest part, I think, of chapters 8 and 9 is dealing with the allowance for doubtful accounts, the aging, and all of that. Okay, so we're going to shift gears and talk about notes receivable. So when we deal with accounts receivable, we're usually selling goods, or services on, well, we're usually dealing with goods at this point. We're selling goods on account, so we're invoicing them, right? Remember those terms like net 15, 2/10 and all of that good stuff, right? The discount terms and everything. So accounts receivable, when we're giving them terms, we're giving them 30 days or 60 days to pay the account in full. We're not charging them any interest though, okay? A note is different. So a note is when we're usually giving them longer to pay, but it's attaching interest, okay? So basically, a note is a formal or written promissory note. So it's a formal written note promising that the debtor will pay, okay? Like I just said. Okay, so again, it's kind of important to know what the parts of the note are, but it's really not that hard. It makes it look like there's so many parts. But the maker of the note is the party making the promise to pay. So the maker of the note is the one saying, oh, I'm going to pay you. The payee is to whom the note is payable. Face amount is the amount that, they're borrowing or that they owe us. Issuance date is the date the note was issued. That's pretty self-explanatory, right? Same with the due date. The due date or maturity date is when they're going to pay us. Right. And then the term of the note is how much time they have between the issue date and the due date. So it could be 30 days, 90 days, 180 days, whatever we agree upon. And then we have an interest rate. So these notes are going to accrue interest. So they're going to pay us the principal amount or the face amount plus interest. Okay, so here's kind of what a note would look like. So instead of invoicing them, there's usually two reasons we issue a notes receivable. It could be we have a company that had 30 days to pay on their accounts receivable, and then they call us and say, hey, we need extra time. Well, we'd rather give them extra time than try to, collect later, right? So we're going to take their accounts receivable and turn it into a notes receivable. So we'll say, sure, we'll give you 90 more days, but we're going to charge you some interest, okay? Or the other way a note would be is that we just loan someone money. So we could actually loan someone money on a note and say, okay, you can pay us back this amount plus interest in 90 days or 180 days, or however long we want to. So here we have the face amount of the note. 90 days is the term. The issuance date was March 16th, and then they have 90 days from that date to pay us back the $2,000 face amount plus a 10% interest, which is pretty high. It's okay though, we like to make money. So we have to usually calculate the due date or the maturity date. We're going to learn how to do that. And then we'll also calculate how much they owe us, the face amount plus that interest. So due dates are kind of fun. So this particular note was issued on March 16th, and it was a 90-day note. So they're kind of showing you the best method of calculating the due date. So it's good to know how many days are in the month. I never learned the little knuckle thing or any of that, but I just try to remember. I know a lot of people did. I'm like, I never learned, they never taught me that. Or if they did, I never learned it. So you do need to know the date, how many days are in each month. If you forget, just, pull up the calendar on your phone or the computer, right? So when in doubt, double check. That's usually what throws people off. So March has 31 days. So normally how we calculate it is we figure out, well, how many days are remaining in the month it was issued? Well, it was issued on the 16th of March. March has 31 days. So 31 minus 16. 15 days will happen in March. There's 30 days in April. Well, that gets us to what, 45 days. There's 31 days in May, which gets us to 76 days. So that gets us up to 76, and we need to get to 90. So that would be 14 more days. So that's how they're getting to a due date of June 14th. Yeah, I'm cool with you opening up. There's a little calendar in the bottom right of your computer. So, or you can bring a printed, yearly calendar if you want to count days. I don't care. So that's how that due date is calculated. So we'll practice one of those too, though. It's always kind of fun, right? So this note was issued on March 16th, and it's due. Here's kind of a visual representation. So March 16th through the 31st was 15 days, plus the 30 days in April, plus 31 days in May. Again, got us to 76 days. So 90 minus 76, it's going to come due on June 14th. It's kind of nice when they show it a different way. Okay. So interest on a note is always calculated by taking face amount times interest rate times the term. So that is just your calculation. Okay. So face amount or principal times interest times the time and days. Okay. You'll notice the interesting thing here is they use 360 days instead of 365. That's what we call the banker's rule. Basically, they do that so it helps us get a more even number, because dividing by 365 days, you usually end up with some crazy decimal, and you may still occasionally, but 360 days is just makes it a little more even as far as our months and our days go. If you think about it, it's an average of 30 days a month then, right? 12 months, 30 days a month. So it just kind of smooths it out a little bit. So we always take the face amount times the interest rate times time expressed in days. So with your time, you're always going to have your days or your term divided by 360. So however many days they get to pay divided by 360. So in this example, the face amount was $2,000 times 10%. times 90 divided by 360, which should be 1/4 or 0.25. Okay, so that will get you your interest amount on the note. So in this example, the interest is $50. So when this note comes due, or this note matures is just another word for due, they're going to owe us the $2,000 plus the $50 in interest. Okay. So like I was saying a minute ago, this notes could replace an accounts receivable. So we had a company that accepted a 30-day 12% note dated November 21st in settlement of an account, which is past due. So WA Bun Company, it's a nice name. Now it makes me think of cinnamon rolls. Just where my mind goes, right? I always love food. They owe us $6,000, and it was due November 21st, and they can't pay. So we're like, that's fine. We'll give you 60 more or 30 more days, but we're going to charge you 12% interest. So all we're doing on this first journal entry is we're turning it from their accounts receivable into a notes receivable. So we're crediting their accounts receivable to clear it off, and we're debiting notes receivable.
So assets will stay the same.
Yes. Yeah, your assets stay the same. You're really just switching it from an accounts receivable to a notes receivable. Okay. So yeah, we'll credit their accounts receivable to show it's no longer accounts receivable, and we debit notes receivable. Okay. If we had issued this note and given them cash instead of to clear off an account, we would just credit cash instead. Okay. So whenever we issue a note, the notes receivable is always debited. And then you just credit either their account or you credit cash because we might be giving them cash. Then when the note matures or comes due, which this one was a 30-day note, so it comes due on December 21st, they're going to pay us the $6,000 face amount plus any interest. And they're showing you how the interest was calculated here. So we took the face amount of $6,000 times the 12% interest rate times 30 divided by 360. So the interest on this was $60. So when this note matures on December 21st, this customer, WA Bun Company, is going to pay us $6,060. I know I'm easily amused. So we debit cash for the full amount, the principal plus interest, or face amount plus interest. We credit notes receivable $6,000 because they're paying us what they owe us. We're clearing it off. And then the $60 of interest that we earned gets credited to interest revenue. Okay. So interest revenue is just a revenue account, you know, just like sales or fees earned or something like that. But it's interest that we've earned. So it's a credit to increase it. Okay. So we count that interest as a revenue. Any questions on that? I heard that. That's what notes are for. You will be allowed to use notes on your test. So, you know, you don't have to memorize all of this information.
Why wouldn't you use our book?
Technically, you probably won't have time to use the book because it'll be in class that we test, but I let you use your notes. And we'll talk about like 1 page, 2 page, that kind of thing. Yeah, when we review. But just a heads up, I usually let financial students use their notes. Okay, let's see. Where are we going? Let's look at an example of a note, and then we'll come back and do this last little part. If they pay on their accounts receivable within the term, a notes receivable will always bear interest. So this one, this example, if you go to the next example in this Engage practice, we have notes receivable. Valley Designs issued a 120-day 5% note for $60,000 dated April 15th to Bork Furniture Company on account. So the first thing it wants to do is determine the due date of the note. So let's see, it was issued on April 15th. Well, how many days are there in April? 30 days, good. So April has 30 days, and it was issued on the 15th. So there's 15 days left in April. We get to go all the way to 120. So then we have May, which has how many days? 31, good. So now we're to 46 days. Then we have June, which has how many days? 30. Good. So now we're at, what, 76 days? Is that right? Yeah, 76 days. And then we have July. How many days does July have? 31. Good. So sometimes I just like to kind of keep a running tally of how many days I'm at. So in this case, what I'm at, 3, 6, 9, 10, 107 days. Okay. Well, this was a 120-day note. So how many days do I have left on it? 13 days. So when I get to August, it's going to come due on August 13th. Basically got that by taking 120 minus the 107. Okay. Everyone understand that? So 15 days left in April, plus 31 days in May, 30 June, 31 in July, got us up to 107 days. So we have 13 days left. So this one is due August 13th, okay? Part B says determine the maturity value of the note. Well, again, in order to do that, we have to calculate the interest first, okay? So I would just follow the same formula that's on the board. In this case, it's a 60,000 face value times a 5% interest times 120 over 360.
$1,000.
Very good. So that would be $1,000 of interest. So what's my maturity value?
61,000.
Did you put? You have to put it in 61,000. It's like you got the interest right, yeah. So the maturity value is the face value plus the interest, the total amount that they're going to pay us. Okay, so 60,000 face amount plus the 1,000 in interest. So they owe us 61,000 when this note matures or comes due. Okay. So on part C1, it says journalize the entry to record the receipt of the note. Well, that's when we issue the note. And this one was on an accounts receivable. Yeah, it was issued on account. So again, here you're just going to debit notes receivable and credit accounts receivable for the face dollar amount, the 60,000. So the note's always issued at the face value, the 60,000. This is from, oh, I put the wrong account on there, didn't I? No, that's right. That's right, yeah. Yes, this is from Bork Furniture, okay? Valley Designs issued a note to Bork Furniture. So we're Bork Furniture Company, and Valley Designs owes us money.
So even if they didn't have an account receivable at first, they still credit account receivable?
Well, this one says it's on account, so they did have an accounts receivable.
Oh. So they didn't say on account, what would you?
If it didn't say, it would say like for cash, or it would be for cash.
So you
You would still debit notes receivable, but you would credit cash. There's really two reasons for a note. It'll always be a credit to accounts receivable or cash. So in this case, it's to Bork Furniture on account. So we're taking away their accounts receivable, but it could be for cash.
Would we never have a name associated with notes receivable?
Sometimes, I think did we do? I don't know why they don't there, honestly, because normally we would. Yeah, it's a good question. And then the last little part of this one says, journalize the entry to record the receipt of payment. Well, what would I debit to record the receipt of payment that they owe us? This is the note, the day of maturity or the due date. Cash, good. For how much?
61,000.
Very good. So cash gets debited, 61,000. And what do I credit?
Notes receivable and interest rate.
Very good. Notes receivable gets credited 60,000 since they've paid it off. And interest revenue gets credited the $1,000 of interest that we've earned. Do it. Yes, yeah, revenue increases on by a credit. So I need to throw that debits and credits page out there. I'm going to make myself a note. Okay. Any questions about that one? Do it.
Why would the revenue be credited? I see what you're saying, but I don't understand that. I feel like,
It increased
Yeah.
on your.
Yeah, you've actually earned interest, right? You've made $1,000 by like extending this. So we charged interest, so that interest is earned money. So since it's earned, we consider it interest revenue. Yeah. So it's just a different form of revenue. Instead of actually selling goods or services, we're charging them interest, but we're still increasing our revenue. Yeah. Okay. Any questions on that one? That's good. Okay. There's one last example, but we kind of need to cover one last thing. Go back in here. So notes aren't too bad. You know, you're just calculating interest and then, you know, the issuance of the note and the payment of the note. The only time they get a little tricky is if they span 2 different accounting years or 2 different fiscal years. Okay. We kind of talked about this briefly in college accounting when we did adjusting entries. We just didn't understand like how we got there. But these are what we call accrued revenues, adjusting entries. So I told you, I think those that you had me anyway, I told you guys, I'm like, this will make more sense when we're in financial. Well, this is that moment. So if you probably forgot chapter 3, but here it is. So in this example, we had Copper Company issues a $4,000 90-day 12% note dated December 1st, 2013 to settle its accounts receivable. Okay. Well, our accounting period ends December 31st. So what happens there is this is a 90-day note. So it got issued to us on December 1st. It's not going to be due till what, like February-ish?
yeah.
But we still need to recognize any interest that has accrued in the current fiscal year. So this one, the note was issued in 2013, and we have interest from December 1st through December 31st, which is the last day of our fiscal year, interest that has accrued. And we haven't recognized it yet, but we need to in the current year. So that's when those fund adjusting entries, I told you they'd come back to you. We have to consider at the end of the year how much interest has accrued. We're not getting paid that interest until the note matures next year. Okay, but we have to recognize the interest that accrued in the current year. So the note gets issued just standard note. December 1st, notes receivable, $4,000 debit, a credit to accounts receivable. There they remembered to put the company name, right? As of the end of the year, we've had 30 days where we've actually earned interest, but we're not receiving it yet. So that's what we call that accrued revenues. If you remember that from adjusting entries, an accrued revenue is a revenue that we've earned, but we haven't received yet.
Okay.
Good times, right? It all comes full circle. So what we do is we calculate 30 days of interest. It's the same interest calculation. Base amount times 12%, but we just want 30 days, 30 over 360, December 1st through the 31st. So that's calculated out to $40. We debit interest receivable because we haven't received it yet. It's just due to us. And we go ahead and recognize that as revenue in this fiscal year.
How did it become 30 out of 360? Instead of a 90-day?
That is just the 30 days left in this fiscal year. Good question.
And so on a separate entry, we would count the rest of the days?
Yes, we would actually then, when this comes due, we would receive all the money. And so we'd recognize the rest of the interest revenue at that point.
Okay.
Yeah.
So we just do, how many days is it?
90 days.
60 days.
It's a full 90 days. So yeah, this is 30 days worth, and then we'd have 60 more days or $80 more of
You gotta make a
interest.
mental note to make it 60.
Yes.
That's just for the first year, right?
Yes, yeah, this is just for this fiscal year, this year one. Okay, so this is what we would do in this fiscal year. Next fiscal year, we would recognize when they actually, the maturity date, when they paid it. I think you asked, how did we do that? Well, this actually came due March 1st. I couldn't count days in my head, right?
Never
So,
mind.
so this is the next year. So March 1 is the maturity date of this full 90-day note. So on March 1st, the company receives the $4,000 plus the full $120 in interest. So as you can see, the first little part stays the same. Cash is received at $4,120. Their notes receivable is credited for the face value of $4,000. This is where it changes. We've already recognized $40 of interest last year. That's where we credit the interest receivable. Well, we've now received that $40.
Okay.
So we cancel out that interest receivable, and we recognize the remaining $80, the remaining 60 days of interest as interest revenue.
Okay.
So all total, they're paying us the $120 in interest. We already recognized 40 of it as interest revenue last year. So we need to recognize the remaining 80 in interest revenue, those 60 days worth in this year. So all of January and February.
Oh, that's why the interest receivable, because
Yeah, this is, we now are getting that paid to us, so it's no longer receivable. That gets a little tricky, right? You have to like adjust a little bit. Any questions on that one? Not right now. I hear that a lot, right? Like, not right now, but I will.
Check with this next week.
Right? It's like, ask again tomorrow.
Yes.
So we do have about 10 minutes, so let's try to get through this last one just so you kind of have it. We'll kind of go quickly. So this one's all notes receivable. December 7th, received from Unitarian Clothing and Bags Company on account a $75,000 60-day 3% note dated December 7th. Well, here we're just issuing the note. So what would I debit and credit to issue that note?
Notes receivable,
Notes receivables debited.
then accounts.
accounts receivable, or no.
Very good. And accounts receivable is credited for the face amount of $75,000. $75,000. Now it wants us to get into that adjusting entry. So it says on December 31st, record an adjusting entry for accrued interest on the note. Well, we wrote this on December 7th, and now we're at the end of our fiscal year. How many days have passed? 24 days. Good. So we need to recognize here 24 days of interest that we've earned that we're not receiving yet. So you would take, 75,000 times, what's the interest rate? 3%? Times 24 days over 360. 150. Very good. So we would debit interest receivable. Very good. And credit interest revenue for the $150. So we earned and accrued $150 of interest revenue in that current fiscal year. Okay. Now they throw in a closing entry. This won't be on the test, but if you remember from chapter 4, all revenue accounts, revenues and expenses all get zeroed out. They're all temporary accounts. So we would need to close out that revenue. So that's just throwing in a nice little review on closing entries. So just to give it to you, we would debit interest revenue to zero it out, and we would credit income summary.
So are you doing the whole month of December?
Well, you're doing the 24 days that have passed. So we issued the note on December 7th, and now it's December 31st. So what we're recognizing there is just the 24 days of interest that has accrued. So we took 75,000 times 3% times 24 over 360. And again, you really don't have to know the closing entry. I think you may have it on your homework too, but it won't be on the test. It's always good to hear, right? And then the last journal entry on February 5th is when that note matures. It was a 60-day note. So this note matures on February 5th, and we're going to collect the full amount due to us. Okay, well, what's the full amount of interest?
Does it say that, or did you do that now?
375. Do what?
Does it say February 5th, or did you do that?
It told us.
Oh, right there.
Yeah, and it did the math for us, so that's always nice, right? So yeah, the full amount of interest would be your 75,000 times 3% times 60 over 360. Would you say 375?
Yeah.
So that's the full amount of interest they're paying us. So what do I debit? Good. For how much? Very good. 75,375. So principal plus interest. What do I credit? And that's for 75. Good.
Interest receivable.
Interest receivable. Good. For 150. Perfect. Interest revenue. 225. Perfect. So again, my interest receivable was from this adjusting entry last year. We've already recognized 150 of interest that they're now paying us. So we credit that to clear it off. Total interest was 375 minus 150 already recognized. So the remaining interest revenue is 225, which you would also get by taking 75,000 times 3% times 36 over 360. It's the days in this year. Any questions on that one? All right.
So are these practices not graded?
No, they're not graded. You just get credit for coming as part of attendance participation.
So when you submit that, I guess you can.
You should still be able to view the report on it, so you should still be able to see it. Go back in and see it.
How do that?
I think it'll be under a different. You'll have to display all assignments. Any questions?